Most people think a credit score is this mysterious number that moves for no reason, but it's not random. In the next few minutes, I'll break down the key things that actually change a credit score in plain English with simple examples you can picture. Quick disclaimer, this video is for educational purposes only. This is not financial advice. Here's the big idea. Your credit score is trying to estimate one thing: how likely you are to repay borrowed money on time, based on patterns in your credit history. And it mostly comes down to a few categories that show how you've handled credit over time. First, payment history. This is the simplest one to understand, and it matters more than people realize. The score cares about whether payments are made on time, because on-time payments are strong evidence of reliability. Think of it like a reputation. If someone has a long track record of showing up when they said they would, you trust them. If they miss commitments, trust drops. Credit scoring looks at that pattern over time. One missed payment can matter, and repeated missed payments matter even more because they suggest a habit, not a one-time mistake. The key idea is consistency, not being perfect for 1 month, but the pattern you build. Second, how much of your available credit you're using. This surprises beginners because you can pay on time and still see your score move around. Imagine a fuel gauge in a car. A full tank means you have room. A near empty tank means you're close to the edge. Using a large portion of what's available can look like you're relying heavily on borrowed money right now. That's why people sometimes see their score dip after a higher spending month and then recover later, even if nothing bad happened. The point isn't a magic number. It's that using less of what's available generally looks less risky than using most of it. Third, the age of your credit history. It's less exciting but powerful because time creates proof. A longer history gives the score more data to judge your habits across different seasons of life. A short history isn't bad, it's just less information. And with less information, the system tends to be more cautious. That's why beginner scores can feel jumpy. Each new piece of data takes up a bigger share of the story. Fourth, the mix of credit types. This is often misunderstood. The score likes seeing that you've handled credit responsibly in more than one form because it's more evidence of stability. Think of it like a resume. If you've successfully handled different kinds of responsibilities, you look more reliable than someone with no track record. But this is not a go collect accounts category. It's more like a small bonus that happens naturally over time. Fifth, new credit activity. This is where a lot of confusion comes from. When new credit is added, like a new account, the system sees more borrowing and a profile that's changing quickly, and rapid change is harder to predict than stable patterns. Imagine someone's spending suddenly doubles overnight. That might be totally fine, or it might be a warning sign. Without context, it's harder to know. Credit scoring reacts similarly to sudden changes. Over time, as things stabilize, this matters less. Now tie it together with one mental model. Your credit score isn't a judgment of you as a person. It's a risk estimate based on patterns. Payment history is the foundation. Do you show up on time? Credit usage is the pressure level. How close are you to your limit right now? Age of history is the evidence. How much proof exists over time? Credit mix is the resume. Have you handled different kinds of credit? New credit is the speed of change. How stable is your profile today versus last month? When you think about it this way, you stop chasing random tips and you start seeing the logic. Once you understand what the score reacts to, you can understand why it moves. A higher balance 1 month might raise the pressure level, even if you're still paying on time. A new account might change the speed of change and shorten the average age of your history. And a long track record of on-time payments builds the strongest kind of trust. So, if your score ever changes and you feel confused, don't panic. Ask one calm question: which category likely changed this month? If this helped, like and subscribe for more beginner finance explained simply.